Stop what you're doing. Put down the coffee, pause the podcast, because what just happened overnight is not a market move, it's not volatility, and it sure as hell is not healthy price discovery. What you're looking at right now is a crime scene, a financial assassination. And once again, CNBC and Bloomberg are standing over the body, telling you it died of natural causes. It didn't. This was mechanical execution. Cold, programmed, pre-approved. And the reason you're confused, the reason nothing makes sense, is because you're being fed ghost signals. Hallucinations. Headlines designed to pacify you while the real assets are quietly being locked behind vault doors in the East. China just restricted metal exports. Let that sentence sit for a second. Not considering, not reviewing. Restricted. And if your first reaction is, well, silver and strategic metals didn't explode, so maybe it's no big deal, congratulations. The gaslighting worked. Because in a real market, in a non-rigged casino, that announcement alone would have detonated prices. Instead, what did you get? A dip, a shrug, a panel of well-paid talking heads telling you it's already priced in. That's how you know you're inside a rigged system. This is not a free market. This is a derivatives theme park where paper claims trade back and forth at the speed of light, while the physical atoms don't a T-move at all. And when physical metal doesn't move, when ships don't sail, when vaults don't refill, the only way to keep the illusion alive is with mechanical execution. Algorithmic V-shocks designed to scare you out of the very thing they are desperately trying to accumulate. Understand the urgency here. Western banks are trapped, not stressed, not challenged. Trapped. They sold promises they can't keep, ounces that don't exist, metal that is now being fenced off by exporting nations who finally figured out the game. China is not playing paper chess. China is playing atomic checkmate. And while you were asleep, while you were scrolling, while you were being told to worry about CPI decimals and Fed whisperers, the plumbing started to groan. Prices in the West moved like nothing happened. Prices in the East told a very different story. That divergence is not a rounding error. It's the sound of the system cracking. This channel exists for one reason, to document the moment when the narrative breaks before the market does. To show you, in real time, how everything is fine is the most expensive lie ever sold to retail investors. They will never ring a bell. They will never say, get out of paper. They will never say, we're short something we can't deliver. So I'm saying it. What you're watching is financial Armageddon in slow motion, sped up by algorithms, masked by headlines, and enforced by a rigged casino that only works as long as you believe digits on a screen are the same thing as atoms in your hand. They're not. And now, the exit doors are starting to close. What you're seeing on your screen right now is not price discovery. It's price suppression via mechanical execution. This is not humans reacting to news. This is machines reacting to pre-approved scripts. Algorithms don't think, they execute. And when you see the same V-shaped smash across metals, bonds, and FX at the same timestamp, that's not fear, that's coordination. Mainstream media wants you to believe markets are emotional, that traders got spooked, that investors took profits. Lies. Markets at this scale are plumbing systems, pipes, valves, pressure releases, and every time the pressure gets too high in physical reality, the paper system releases it by smashing price, not because value disappeared, but because belief must be managed. Bloomberg will flash a headline. Metals slide on strong dollar. CNBC will say, silver falls as traders digest China news. Digest? There's nothing to digest. China restricting metal exports is a supply shock, full stop. In any honest market, supply restriction equals higher prices. If the price goes down, the signal is inverted, which means the signal is fake. These headlines are ghost signals. They are narrative hallucinations injected after the fact to justify moves that were already queued up in the machine. The price action comes first. The story is written later. That's how you know this is theater. Let me make this simple. Real markets clear through delivery. Fake markets clear through cash settlement. The Western system is drowning in paper derivatives. Futures, options, swaps, all referencing metal that mostly never moves. It's digits, trading digits. And as long as nobody asks for delivery, the illusion holds. But something changed. Physical demand didn't politely follow the script. Industrial users didn't wait for permission. Nations didn't ask the lbma if it was okay to secure supply. They looked at the geopolitical board, they looked at sanctions, weaponized currencies, frozen reserves, and they said, we're done trusting paper promises. So when China restricts exports, that's not a headline. That's a declaration. It's a statement that physical metal is strategic. That it's not just an investment, it's infrastructure. Energy, defense, survival. And that terrifies a system built on rehypothecation. Here's where the mechanical execution comes in. The moment real-world constraints appear, the algorithms are triggered to do one thing. Cap price, smash volatility, maintain confidence, because confidence is the only collateral left. If price were allowed to reflect reality, the entire derivative stack would implode. So they hid it at low liquidity hours, with maximum leverage, selling metal that doesn't exist to push the price of metal that does. And then they parade analysts on television to tell you it's healthy consolidation. No, it's a controlled demolition. And you can tell it's controlled because the same fingerprints are everywhere, the same sell patterns, the same recovery ramps, the same talking points. Over and over again, this isn't randomness, this is enforcement. The mainstream wants you focused on narratives because narratives are soft. Mechanical reality is hard. Mechanical reality says this: inventories are not growing. Delivery times are not improving. Scrap flows are tight. Premiums are rising. East versus West pricing is diverging. Those are facts. They don't care about opinions. Yet the price on your screen tells a different story. Why? Because that price is not for metal. It's for leverage. It is the price of confidence in a system that requires you to never ask for the thing you think you own. This is why they ridicule stackers. This is why they mock physical holders as paranoid or old-fashioned. Because physical metal is an audit. It's a truth test. It forces settlement. And the moment too many people choose atoms over digits, the game ends. So the lies have to get louder, the gaslighting more aggressive. You'll hear phrases like ample supply, well-stocked inventories, no signs of stress. Meanwhile, industrial buyers are locking in contracts years out. Governments are quietly securing stockpiles. Vault reports get delayed, revised, or quietly reclassified. Mechanical execution requires your participation. It requires you to believe that a futures contract is the same as a bar, that an ETF share is the same as delivery, that counterparty risk doesn't matter because it's all regulated. Regulated by who? The same institutions that are short the metal, the same banks that need price down to survive, the same system that has never once admitted fault, only unexpected events. This is why nothing you're seeing is natural. Natural markets don't behave like this. Natural markets don't ignore supply shocks. Natural markets don't move in perfect geometric patterns. Natural markets don't require daily narrative reinforcement. What you are watching is a rigged casino fighting the last war with the last tools it has: leverage, speed, and narrative control. But mechanical reality always wins. Pipes burst, pressure escapes. And when it does, there's no headline that can put the atoms back in the vault. This is the foundation you need to understand before we go any further. Because once you see the mechanics, the rest becomes obvious. Now let's do what mainstream media refuses to do. The math. Not opinions, not feelings. Arithmetic. Because numbers don't lie, they expose. And look at the physical markets in Shanghai and Tokyo. Not the paper proxies, not the comex print. The real bids, the real asks, the metal that actually changes hands. In Shanghai, physical silver clearing north of $89 an ounce equivalent when you adjust for taxes, premiums, and conversion. In Japan, industrial grade material locking in closer to $130 when you factor in fabrication demand and delivery guarantees. And then you look at New York, 71. That is not a spread, that is a fracture. In a functioning arbitrage system, that gap cannot exist. It gets closed instantly. Traders buy the cheap market, sell the expensive one, move the metal, pocket the difference. That's how price discovery works. That's how the invisible hand is supposed to operate. Except here's the problem. The metal isn't moving. No ships, no surge in exports. No flood of bars leaving Western vaults to satisfy Eastern demand. Which means the arbitrage mechanism is broken. And when arbitrage breaks, it's because one side of the trade is fake. Paper can move instantly. Physical cannot. And the moment physical constraints appear, paper prices become fiction. That's what you're witnessing right now. The Western price is not the price of silver. It's the price of leverage. It's the price of confidence that if push comes to shove, delivery won't be requested. The Eastern price is the price of reality, of factories that need metal, of supply chains that can't run on press releases. So why hasn't the gap closed? Because the metal backing those Western contracts is either already spoken for, already leased 10 times over, or simply not there. The banks know it. The industrials know it. And now exporting nations know it. This is why China's restriction matters so much. It's not about today's volume. It's about tomorrow's availability. It's about signaling that physical supply is strategic, not optional. And once that signal is sent, the Eastern buyer stops trusting Western benchmarks. They start pricing independently. That's how empires lose control, not with explosions, but with parallel systems. Two prices for the same metal, one for paper, one for atoms. And the spread between them is the measure of distrust. The mainstream will tell you, oh, it's just local premiums. No, premiums don't triple without cause. Premiums don't stay elevated for months without resolution. Premiums are the market screaming that the quoted price is wrong. And here's the part they really don't want you to think about. If arbitrage were possible, Western banks would already be doing it. They would be buying at 71, shipping to Shanghai, and selling at 89 or 130. That's free money. Banks live for free money, so why aren't they doing it? Because they can't source the metal. Because what they have is paper. Because the moment they try to convert digits into atoms at scale, the vault doors echo. This is the trap. Western banks sold the world synthetic supply. It worked for decades because nobody challenged it. But now the East wants delivery, not exposure. And delivery is where the fraud becomes visible. You don't need conspiracy theories. You don't need secret meetings. The math is enough. A persistent, widening arbitrage gap is proof of failure. It means price is no longer clearing the market. It means the reference benchmark is broken. And when benchmarks break, systems reset. This is why you're seeing such violent mechanical execution in New York. The algorithms are trying to defend a number that no longer reflects reality. They are smashing price to discourage demand, to scare weak hands, to keep metal from leaving the system. But the East doesn't care about your screens. They care about tonnage, about delivery schedules, about inventory they can touch. So while you're being told silver is weak, industrial buyers are paying whatever it takes. While you're told there's no shortage, contracts are being rewritten with longer lead times and stricter terms. While analysts debate RSI levels, the physical market has already moved on. This is the quiet part. Arbitrage only works when trust exists. Trust that a contract represents something real. That trust is gone, and once it's gone, no amount of paper selling can bring it back. The divergence you see is not temporary, it's structural. It's the beginning of bifurcation. Two systems, two prices, two realities. One built on leverage and narrative, one built on atoms and necessity. And history is very clear about which one survives. Now ask yourself this. If you were a bank sitting on a mountain of short exposure, watching the physical market decouple, watching exporting nations restrict supply, watching industrial demand accelerate, what would you do? You wouldn't admit it. You wouldn't ring alarms. You would go into the plumbing. You would inject liquidity. You would manage optics. You would quietly reposition. And that's exactly what they did next. Follow the money. Not the headlines, not the speeches, the plumbing. Because when something breaks in the system, the fix never happens on television. It happens at 3 a.m. in the repo market. You were told liquidity is ample. You were told the system is well capitalized. And then, quietly, $17 billion shows up. Then 34. Then another operation. Overnight repos, term repos, standing facilities, different names, same function, emergency oxygen. This is not stimulus. This is not fine-tuning. This is a bailout without a press conference. Repo is where banks go when they don't trust each other. It's where collateral gets questioned. It's where risk-free assets suddenly need haircuts. And when the Fed steps in aggressively, it's not because everything is fine. It's because something is clogged. What's the collateral in this system? Treasuries, sure, but also commodities. Also metal-linked paper. Also derivatives stacked on top of derivatives. And when the value of that collateral becomes suspect, when the physical backing is questioned, the whole chain tightens. This is why you saw those injections line up perfectly with metal smashes. Not coincidental, coordinated. When the pressure builds on one side, they release it on another. Smash the price, stabilize the books, keep the game going one more day. The Fed will never say, we're saving bullion banks. They'll say, we're ensuring smooth market functioning. Translation, someone important is in trouble. And here's where the blue whale flip comes in. For years, the largest banks were structurally short metals, not as a trade, as a business model. Short volatility, short supply, long confidence. They made money as long as price stayed contained and nobody demanded delivery. But look at the positioning now. Slowly, quietly, the shorts start to cover, the longs start to appear. Not all at once, that would spike price. No, this is done surgically. Through options, through OTC swaps, through off-exchange deals that never hit a screen. That's the flip. From suppressor to accumulator. Retail is taught to buy tops and sell bottoms. Institutions do the opposite. They engineer the bottom. They manufacture despair. And while you're being told silver is dead money, the largest players are changing sides. Why? Because they can see the same things you can, only earlier. Export restrictions, arbitrage failure, fault drains, industrial demand curves that don't bend. They know the paper game is reaching its limits. So they do two things at once. Publicly, they maintain the narrative. Privately, they secure exposure. They hedge their own fraud. They prepare for a regime shift. This is why repo matters. It's not about rates, it's about collateral quality. When the system starts questioning what's real, liquidity has to be injected to prevent a chain reaction. And don't let anyone tell you these are routine operations. Routine doesn't spike. Routine doesn't expand eligibility. Routine doesn't coincide with stress in multiple asset classes at once. This is firefighting. And you can see the smoke in the vault data, the stuff that still gets reported. Comex registered inventories trending down, eligible metal reclassified. Bars moving categories without moving locations. Asahi numbers tightening, delays, revisions. Silence. Physical metal doesn't vanish, it exits. And every ounce that leaves is an ounce that can hope to be used to back 100 paper claims. That's the math they're terrified of. So the Fed steps in, liquidity gets injected, banks get breathing room, and the price gets smashed to slow the drain. It's a feedback loop, plumbing, not markets. This is why the word secret matters, not because it's hidden, because it's normalized. Emergency measures presented as maintenance, bailouts framed as policy tools. The public isn't supposed to notice. You're supposed to argue about basis points while the foundation is shored up underneath you. But here's the catch. Liquidity can fix solvency optics, not physical shortages. You can print dollars, you cannot print silver, you can extend credit, you cannot extend atoms. Every intervention buys time. None of them solve the core problem. Too many claims on too little metal. That's why the banks are flipping. That's why the East is locking supply. That's why industrials are signing long-term contracts. And that's why the narrative is getting more aggressive, not less. Because the window is closing. The repo injections are the smoking gun because they tell you stress exists where you aren't retold there is none. They tell you the system is reactive, not in control. They tell you someone big needed help. Now. And when institutions need help in a supposedly booming economy, you should ask what they're not telling you. They're not telling you that the paper market is losing credibility. They're not telling you that delivery risk is being priced behind the scenes. They're not telling you that the exit doors for physical metal are narrowing, but you can see it. In the math, in the injections, in the positioning, in the silence. This is the phase where the system pretends stability while preparing for change. And the next pressure point isn't financial, it's industrial. Because when industry needs metal and the vaults can't deliver, the conversation changes fast. Industry doesn't negotiate with narratives. It doesn't care about forward guidance, dot plots, or carefully worded denial statements. Industry needs inputs, and when those inputs don't show up, everything downstream breaks. This is where the story turns from finance to physics. Look at what's happening in industrial demand. This isn't jewelry, this isn't coins in a sock drawer. This is mission-critical usage, solid-state batteries, power electronics, military systems, medical tech, EV platforms that don't work without specific metals in specific quantities. Samsung didn't announce solid-state battery breakthroughs for fun. Those designs are metal-hungry, silver-intensive, orders of magnitude more demanding than legacy lithium-ion, roughly a kilogram of silver per vehicle when fully scaled, not as an estimate, as an engineering requirement. You can't substitute that away with a spreadsheet. Now put that next to China restricting exports. That's not coincidence, that's sequencing. China controls refining, processing, intermediate supply. When they restrict exports, they're not just tightening availability, they're prioritizing domestic industry. They're telling the world, our factories come first. And if you think Western automakers, defense contractors, and grid operators haven't run that math, you're not paying attention. This is why silver is no longer just an investment metal. It's unobtainium, a war metal, a choke point. And when a metal becomes a choke point, it stops flowing through open markets. It gets locked up, contracted, hoarded, secured behind government-adjacent doors. You can see it in the vaults. Comex registered inventories don't drain in a straight line. They drain in steps, quiet exits, category shifts. Eligible becomes registered, registered becomes eligible, and then nothing moves. Until it does. Bars don't disappear. They leave the system. Asahi Vault data tells the same story. Reduced availability, tighter turnover, less metal willing to sit idle for yield. Because when demand certainty rises, opportunity cost flips. The metal is more valuable in use than on a balance sheet. This is what mainstream analysis misses completely. They think supply is static and demand is elastic. In reality, strategic demand is inelastic. When a factory needs metal, price is secondary. Availability is everything. So what happens when industrial buyers show up to a market designed for speculators? The market breaks. Futures markets are built for hedging flows, not existential demand. They assume that if price rises, supply appears. But what if supply is politically constrained? What if it's already spoken for? What if exporting nations decide metal is too important to ship? Then the futures curve lies. And when the curve lies, vaults get drained. This is why the word exit keeps coming up. Physical exit. Metal leaving the system where it can be leased, rehypothecated, and promised 10 times over. Every ounce that exits reduces the system's ability to pretend. And the response is always the same. Smash the price. Scare demand. Delay the inevitable. But here's the problem. You can't scare industry. You can't tell a battery plant to wait for confirmation. You can't tell a defense contractor to buy the dip later. They secure supply or they shut down. So while price action screams weakness, physical flows scream scarcity. That's the disconnect. That's the tell. Silver is being treated like a strategic resource in the real world and like a meme asset in the paper world. Those two views cannot coexist indefinitely. One will dominate. And history tells you which one. When metals become strategic, they get nationalized in everything but name. Export controls, stockpiles, long-term contracts, reduced float, that's already happening. And once that process starts, there is no rewind. You don't wake up one day and say, actually, let's go back to free flows. Strategic resources don't go back in the box. This is why the vault drains matter more than any chart. This is why industrial bombs matter more than CPI prints. This is why silver being called unobtainium isn't a T hyperbole. It is a warning. The system was built on abundance assumptions that no longer hold. It was built on the idea that metal would always be available if price was right. That assumption is dead. And when assumptions die, models fail. The West is learning, slowly, painfully, that you can't sanction, financialize, and weaponize the global system and expect raw materials to remain apolitical. The East learned that lesson years ago. So now you have two trajectories. One side scrambling to manage price optics, the other side locking supply. That's not a cycle, that's a regime shift. And once you understand that, the final question isn't what's the price, it's what's the plan? Because the next phase isn't about watching charts. It's about positioning for a world where digits and atoms finally part ways. And that S where we end, with the only thing that matters when systems change, survival strategy. Here's the part nobody on television will ever give you. The battle plan. Not investment advice, a survival guide for a system transition. Because when regimes change, you don't get a calendar invite. You get volatility, confusion, and lies. And the people who survive aren't a T the smartest. They are the ones positioned before the rules change. Rule number 1 is what I call the 5 and 200 rule. 5% of your attention should be on headlines. 200% should be on mechanics. Headlines are designed to move you emotionally. Mechanics tell you what's actually happening. Vault data, export controls, industrial contracts, repo injections, that's the signal. Everything else is noise. Rule number 2, digits are promises, atoms are settlement. If your wealth exists entirely as a number on someone else's balance sheet, you are the unsecured creditor in a stressed system. You don't own an asset, you own a claim. And claims are what get restructured, delayed, gated, or cash settled when pressure hits. This is the moment of the digits to atoms shift. Not all at once, not in panic. Methodically, intentionally. You don't need to predict the top or bottom, you need to reduce counterparty risk. Physical metal isn't about getting rich quick. It's about staying solvent when paper games end. It's about optionality. About having something that doesn't need permission to exist, something that doesn't care about repo windows, trading halts, or emergency regulations. Rule number 3, ignore price, watch availability. Price is the most manipulated variable in this entire system. Availability is the truth. When lead times extend, when premiums detach, when contracts get rewritten, that's the market speaking honestly. And finally, understand the timeline. This doesn't resolve in a week or a month. This plays out as a grind, pressure, intervention, calm, repeat. Each cycle drains a little more physical supply and exposes a little more of the paper illusion. By 2026, this becomes a battle between systems. A leveraged, narrative-driven Western paper market versus a physical, industrial, state-backed Eastern supply chain. One side can print, the other side can deliver. History has already told you how that ends. You don't need to be perfect. You just need to be early enough. The people who wait for confirmation always get it. After the move, after the restrictions, after the gates close, the people who act on mechanics don't need permission. This channel isn't here to make you comfortable. It's here to make you aware. Because awareness is the only edge left in a fully financialized world. The casino is rigged, the exits are narrowing, and the only real hedge against a system built on promises is something that exists whether the system approves or not. I will see you on the other side. Like, subscribe, and share.